Welcome back. In this session, I will continue my introduction of the conceptual framework and explain to you what are the qualitative characteristics. First, we need to see what is contained in the conceptual framework. A conceptual framework contains 8 chapters: the objective of financial reporting, qualitative characteristics of what it means by a useful information, financial statement and a reporting entity, the element of financial statement, recognition and derecognition, measurement, presentation and disclosure, concepts of capital and capital maintenance. We could divide these 8 chapters into 3 levels. The fundamental corner part is the objective of financial reporting. Second levels are the qualitative characteristics and the element of financial statement. Third level would touch on assumptions, principles, and constraints. The first level, basic objective. To assist the board in development of new standards and review of existing standards. To assist the preparers to develop consistent accounting policies when there's no standard applies, or when a standard allows a choice of accounting policy. To assist all parties to understand and interpret the standards. As we have said, it's not the standard, so do not override any IFRS. Let's have a close look of what they say. If you could have the conceptual framework document side by side, I would like you to read this particular paragraph. The objective of the general purpose financial reporting is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. As a highlight here, it's very important for you to see the idea of the financial reporting is to enable decision making and to provide useful information to enable that decisions. And what would be constituted as a useful information? So it continued to say, to make those informations, if we stand from the perspective of the users, they would need information about economic resources about the entity, claims about and against the entity, and changes in those resources and claims. So if imagine yourself as one of the investor or someone who borrowed the money to the company, what would you like to know about the company? You would want to know the performance, how it performed in the last year, what kind of the asset it owned. You would also want to know what kind of the inventory it holds. You would also want to know how much money it has borrowed, like what other liability it has. And you also want to know the changes in the asset value or in the liability. So the general purpose of the financial report may not able to provide all the information that existing or potential investor, lenders, or other creditor needs. So the users maybe need to consider other sources of information as well. One other thing to note is in this illustration of users, it is clearly that they did not actually include other people, for example, the government, public, management, or employees. The general purpose of the financial report is not designed to show the value of the reporting entity. So after you have read the financial statement, you will not get a figure of how much this company is worth, because that value is reflected in the share price and is reflected in the capital market. But rather the information is helping the users to estimate the value of the reporting entity. So if you see an increase in the revenue and you kind of expecting for the next few years this increase will continue, then this would reflect in their share price, showing a good potential that this company does have a good performance in the next 5 years. So I would like you to think about, we talked about providing useful information to these users. First of all, you need to think, what do we mean by useful? What be considered as useful? Do all users would want similar useful information? Do all users have similar needs, or do they have a different needs? If you have finished your thinking, you can proceed to the next slides. At the second level, it introduced the qualitative characteristics of what it means to be useful information. So what would be a better, more useful information than less useful, inferior information? Fundamental characteristics are relevance and faithful representation. Enhancing ones are comparability, verifiability, timeliness, understandability. The first fundamental characteristics is relevance. So decision makers would want relevant information so they can make a decision. It's often easier to draw a line between relevance and irrelevance, but it was less easier to do a division between more relevance and less relevance. So the conceptual frame provides several considerations that could help you to think about what it means to be more relevant. So it said if it provides predictive values so that you can look forward and do some forecasting that helps your decision, or it allows you to look backwards to confirm some of your judgments, or the information itself carry materiality. So it's quite important information, and any omission or misstatement or obscuring of it would strongly impact on the decision. But when we talk about materiality, it's often a very specific aspect. It's specific about a particular entity. So if we're thinking about an extractive industry, an oil and a gas company, information like how they're going to remove the polluted water or infrastructure that they have constructed would be very important and material than this kind of information to a company that is doing like IT services. And materiality also would depend on the nature and the size of the item. So what it is about and how big it is. And there was no way that you can actually draw a benchmark of saying, well, if the value is over 500,000, then it was considered as very material. And when there is a size which is less than 500, is not. So you wouldn't be able to actually draw such a particular line to decide which is more material and which is less. It's very much depending on your own judgment. So you need a professional judgment in order to establish case-by-case decisions about what you see as material to publish in the financial statement. Here are some examples of different standards that requires you to take account for materiality. In IS1, it claims that the disclosure required by the IFRS need not be made if the information is considered as immaterial. According to IS8, it also said, if a financial statement contains material errors, then it would be considered as do not compliant with IFRS. It also said in this particular standard IS8, accounting policy that set out in the IFRS need not to be applied when the in fact of applying them is immaterial. The other fundamental characteristics is the faithful representation. It means that financial information must represent faithfully in words and numbers the substance of the economic phenomena it purports to represent. And to achieve this, it must be complete. That means to include all the information necessary to understand the phenomenon depicted. It also means that it needs to be neutral, without bias in the selection or presentation of the financial information. It should also be free from error, no error or omission in the description of the phenomenon, or the selection and application of the process to produce the information represented. The The idea of faithful representation is also being integrated into various standards. In IS1, it said financial statements should present fairly the financial position, performance, and the cash flow. It also said that fair presentation requires faithful representation of the facts of the transactions, other events and conditions in accordance with the definition and recognition criteria for asset, liability, income, expenses. The application of IFRS with additional disclosure when necessary is presumed to result in financial statements that achieve a fair presentation. The four enhancing qualitative characteristics are comparability, verifiability, timeliness, understandability. Comparability refers to that users can use the information to understand similarities as well as difference. They can compare this year's performance with last year's. They can also compare across companies and also across countries. Verifiability means that the users are assured that information are faithfully representing the economic phenomena. Timeless, which means that information should be available in time. Otherwise, when the information becomes outdated, it's no longer relevant to decision making. Understandability, it refers to classifying, characterizing, and presenting information clearly and concisely. It should not be an excuse for not presenting any complex economic phenomenon. In fact, those complex phenomena should be presented in a way that should be understandable to the users, so it's not going to be obscuring the users.